Welcome, ladies and gentlemen, to Lesson 2, Preparing Journal Entries for Common Business Transactions, Balance Sheet. Like in the Lesson 1, we're not very creative here with our titles, so what are we going to do in this lesson? Well, we're going to prepare journal entries for common business transactions specific to the balance sheet. Alright, now, if you remember from Lesson 1, we talked about the basics of a balance sheet and the basics of business transactions. Now we're going to get into specific transactions, common transaction, but more specific transactions. Before we start, in Lesson 1 we talked about the three different types of transactions: operating, investing, financing activities. Well, each of those type of activities or transactions has three different types of transactions within it. You have observable external events, observable internal events, and unobservable events. So, each transaction can have an observable event, an unobservable event, observable being external or internal, and then the unobservable. And I'll read the definition here. Observable external events are exchanges involving assets, liabilities, and stockholders' equity that you can see between the company and someone else. All right. Observable internal events are events occurring within the company. For example, using some assets to create an inventory of product. Remember, in the manufacturing company from Lesson 1, we took raw materials and we manufactured a product. Okay, well, that's an observable internal event. We're taking a good and we're creating another good, so that's an event we can see. An unobservable event, unobservable events are events occurring that cannot be seen. For example, interest costs increasing on a bank as time passes. We have a note payable, and as time passes, we're going to owe interest on that, but it's not an immediate exchange. It's something we can't see happen. We can't see the interest being accrued. There's nothing being exchanged at that point. It's happening, but we don't see it. That's an unobservable event. And remember, we can have any of these three types of events or transactions happening for the other, operating, financing, and investing. All right. That being said, those are going to be the type of events we're going to look for in terms of business transactions. Are they operating activity or operating, investing, financing? And of those, if it is operating, is it observable internal, observable external, or is it unobservable? All right. I think you get the concept. We're going to move on, and we're going to get into really the crux of accounting, and that's recording transactions. Accounting is about recording and creating the history of the business transactions. So exactly how do we record, or how do we create this history that then goes into the financial statements? The first thing we got to understand is a journal. Back in the old days, just like you and I can have a journal where we write the notes for the day. Back in the old days, businesses had these big books or journals where they would record every transaction. Nowadays, this is all computerized, but we have the legacy of the word journal. So imagine this old journal with all these transactions. You write them each down. Okay, that's what a journal is. We're recording each transaction as it happened. That's a journal. Okay, and then when we're talking about a journal entry is an entry into that journal. A transaction happened. Let's write the journal entry. All right, so stepping back, none of this happens anymore. It's all computerized, but that's where we get the terminology for it, okay? Moving on. So a journal entry always has two sides that equal a debit on the left and a credit on the right. Debit left, credit right. Remember that. Every journal entry is going to have a debit on the left, credit on the right. It can be multiple entries on either side, but it's going to need to have at least one debit, one credit, and the total sum of each of the debits and credits is going to need to equal. That's a journal entry. A journal entry needs to equal, it needs to have a debit, it needs to have a credit. Alright, so we got this big journal, we got a business transaction, and we record a journal entry, a debit, and a credit. Alright, now a ledger is a collection of all the records. So we've got the journal entry, we got a journal, we got the journal entry, and then we got a ledger, which records all those transactions. Right? It's a collection of records, and it summarizes those transactions. A ledger summarizes all the journal entries, and so we have a journal entry, transaction, and then the ledger will just summarize all those journals. So each time we make a journal entry to revenue, the sum of those entries will summarize and we'll put into the ledger as that ledger balance for revenue in that case. Okay, these may be difficult concepts. You can watch this lesson again. Just try and understand, okay, we got a transaction. We need to record the transaction in the journal. How do we do that with a journal entry? What does a journal entry have to have? It has to have a debit and a credit. The debit and credit have to equal. Debit left, credit right. So a T account is a simplified version of a ledger. All right. And we'll get into what, in the lesson plan we have T accounts, and I'll show you what a T account is, but basically a T account has a left and a right side, just like a journal entry has a left and a right side, a debit and a credit, and then we sum those, and then we have an ending balance, and that's our ledger balance. Our ending ledger balance just summarizes all the different transactions. We make journal entries in the T account, all the different transactions, and then the ledger balance summarizes that. That's the bottom. It's the sum of all those. So a T account has our ledger balance at the bottom and all the journal entries at the top. Okay. So T accounts, we'll get into that, but that's the definition. Okay. In every transaction, I think I covered this. All the debits and all the credits need to equal. Keep in mind the duality effect. Okay, as we set sail on HMS Roundbelly, as we go on this journey into the accounting world, this very boring, bland world that we're going into, that is accounting land. Remember, there's this duality effect. For every transaction, two events happen. If I give money, I get something. If I get money, I give something. Alright, so there's this duality effect. There's always a debit, there's always a credit. There's two people, it's like your doppelganger. There's this opposite of you everywhere you go. There's this other thing, there's this opposite side of the entry. There's this debit and there's this credit. Alright, so remember the duality of effect. There's always two sides to every journal entry. Just like there's two sides to every story, right? Effects of journal entries on accounts. Remember the basic accounting equation: assets equals liabilities plus stockholders' equity. All right. When we make an entry into our journal, we're going to have to hit maybe two asset accounts. Well, and we'll get into what accounts are. But okay, so we got assets, we got liabilities, stockholders' equity. That equation always needs to equal, just like our balance sheet equals. If it doesn't, it's just a sheet. That equation has to equal. So when we're talking about journal accounts and the effects of a journal entry on an account, asset accounts increase on the left, they decrease on the right. You'll see in a T account, assets increase on the left, decrease on the right. Liability accounts, they decrease on the left, increase on the right. Same as stockholder equities accounts, they decrease on the left, increase on the right. They have to, liabilities and stockholders' equity go the same way, and opposite an asset, so that the equation always equals. The asset always equals liabilities plus stockholders' equity. I know this sounds like algebra, but basically accounting, it's kind of is, because that equation always needs to equal. And so where do we put the pieces of each journal into that equation? Well, that's what accounting is, right? All right. So moving on, a balance sheet. How do we get from this journal, the T account, to the balance sheet? Well, the balance sheet, the ending balance of our T account is what goes into the balance sheet. And you'll see how that works when we flip over the cheat sheet and we get into the actually recording transactions. Now, historical cost concept. I'll read this definition, and you'll have to read it one more time. It's just this concept that it's pervasive throughout accounting, and we have to follow it. All right. Assets and liabilities are initially recorded at their original cost to the company. This historical cost principle is one of the main principles of accounting. All right. Always at the initial amount recorded. Right. It's the original cost. That's what we recorded at. All right. If we paid $500 for this piece of equipment, we record it at $500 and we keep it at $500. Historical cost, we always keep it at that same cost, $500. The value may go up, but we keep it at that $500 because that's a historical cost to the business. Our equation always has to equal, so we can't be changing that value because then we'd have to change something else on the other side of the equation, and we don't want to do that. We want to keep it at the historical cost so that our equation always equals. All right. Trial balance. This is a concept and a thing we're going to have to understand. The trial balance in accounting, the trial balance is a worksheet listing the balances at a certain date of each ledger account in two columns, namely debit and credit. So trial balance is a listing of all of our general ledger accounts or ledger accounts. I've included an example, Roundbelly's chart of accounts These are the balance sheet accounts. These are standard accounts that you'd see in a ledger for when you're making your journal entries. Okay, so we got cash, accounts receivable, accounts payable, contributed capital, retained earnings. I'm not going to go through the definitions because you have them here. You can study them. They're also included in the flashcards. But just understand that the trial balance, okay, this is a chart of accounts. This just shows us what the name and number of our account and a description. It doesn't have the balance. Okay, so we got the chart of accounts, but then our trial balance has the account number, the account name, and then the balance at a certain date of each of those accounts. All right, that's the trial balance. And you'll see I've tried to break this out to give you the flow to the balance sheet, because we go from the trial balance or the chart of accounts into the balance sheet, and I've broken out this darker blue up here. There's a portion up here that's current assets that will be used within the next 12 months or a year. And we got this portion down here. These are long-term assets, resources that won't be used, or they're going to be used for a longer period of time, more than a year or after a year. So that's this long-term portion. Similar, liabilities, you have a current portion and a long-term portion. Now, in this sort of pinkish, peachish color, you got current liabilities. These are debts or obligations that will be paid or settled within the next accounting cycle, or year, whichever is shorter. And then you have these long-term liabilities, which are debts or obligations that will be settled after 1 year or the accounting cycle, whichever is shorter. Typically it's a year. I've never seen it any other way, but a year. Okay, so just remember this is a year. Then down the bottom, also included in the balance sheet in this sort of lighter green color, we got stockholders' equity. Okay, so these are our stockholder equity accounts, the contributed capital and retained earnings. Retained earnings is in our statement of stockholders' equity. This is the account that in account we record transactions via journal entries. We record journal entries. The ledger shows the sum of all the transactions that happened. All right. And that's what a trial balance is. It lists these accounts and our ledger balance, a sum of the balances that have happened at a given date, right? And we'll get into this as we go through the transaction. Okay, those are the basic concepts. Now, let's move into some transactions here. Flip over to cheat sheet. And what I've done is I've come up with an acronym, something that's going to help us as we go through each transaction. It's a way to start the transaction, and the way to start a transaction and start the analysis of an accounting transaction is go through these first steps. First step, stop. Remember, accounting's easy if you follow this methodology, right? Accounting is easy. Second, T, transaction. Does a transaction exist? Have goods or services been exchanged? If yes, move on. If no, stop. Like we said, there's observable events, internal or external observable events. Did one of those happen? Did assets and resources, did something get exchanged, cash paid, goods received? Did something happen? If yes, okay, then move on. If no, if nothing was exchanged, then there isn't a transaction. There's no journal entries. There's nothing to record. So remember, number 2, observable external, observable internal, or unobservable. So we can have unobservable events that we need to record, but if there's no event, there's nothing that happens, no exchange, don't do anything. Moving on. 3A, accounts affected. Identify which accounts are affected. Is it an asset account? Is it a liability account? Is it a stockholders' equity account?